From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, May 19th, and you're listening to the Macrocast. I'm Meghan Pennington from Hamilton Place Strategies, filling in for Tony, and joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. We also have a special guest, Dennis DeBusschere, joining us today. Dennis is president and founder of 22V Research, a new boutique research firm focused on investment strategy, analysis, and policy research. Welcome, Dennis. We're really excited to have you on today's Macrocast.
Oh, thanks for having me. I'm excited to be here.
Awesome. Well, let's start with recession fears. Guys, what are we hearing?
Yeah, this was a week where recession concerns really began to become more mainstream. You know, there were some, tweets about Google search terms of recession going up. And certainly this has been percolating for a while in financial markets. We've seen the classic recession indicator of the yield curve, the Treasury yield curve inversion in early April, which always sets alarm bells off on Wall Street. And for just to explain the 2 and 10 year differential in yields is what people call the yield curve. And when the 10-year yield goes below the 2-year yield, which it shouldn't do, it's a traditional, almost no-fail recession signal. And that occurred very briefly in early April. So it has been in the atmosphere. We've been seeing equities repricing for more dismal growth outlook, and obviously the challenges of inflation alongside that. So truly stagflationary concerns. Thoughts about the Fed potentially over tightening into this supply shock. And we got, what was the smoking gun this week? You really couldn't see. It was more like this incremental drip, drip, drip of evidence and concerns. This week we saw, retail sales and industrial production in the U.S. And there wasn't a smoking gun there, but we saw some, we heard some pretty downbeat commentary and some squeezed margins from major retailers like Walmart and Target, and that really, I think, that put the fear into the equity crowd this week, and furthered this narrative about an impending recession later in the year. Surveys of CEOs are showing more and more of them also predicting this contraction in the U.S. economy by year end.
Dennis, what are you guys seeing?
Yeah, I mean, this week, I would agree with you. This week and last week, the recession risk certainly leveled up a little bit. I think when I think about in terms of market, what led to that kind of, I'll use a technical term here, puke on Wednesday was obviously a significant decline, was actually the strong retail sales data. Mm-hmm. So when we talk to clients, and, I think this is common kind of theme on Wall Street, is you're sitting here at a 30 vol, right? So the VIX is at 30, and it's at 30 going out 6 months. So implying 2% daily moves for 6 months. Now,
which is like unprecedented.
Unprecedented. Like, so who can buy that? Like, who's willing to do anything? Now, one of the questions you have to ask yourself is like, well, why the heck is it at 30 vol for 6 months? Sometimes when we see extreme stress in the markets, as you guys know, usually get front month volatility up a lot, but the back end of the curve is lower, meaning that it's kind of short and intense. And then that at least gives some traders a signal that you might want to buy the market because volatility will decline over time. Well, there's no volatility declining priced in. Now, one of the reasons that's the case, which gets back to my retail sales / recession risk, which are maybe at odds with each other on its surface, they're actually not. We know the Fed needs to slow inflation, right? Right. When we know the economy needs to slow to respect supply side constraints. And when I say supply side constraints, I'm more focused on labor and housing than I am on supply chains in this particular instance.
Yeah. And also I like that you say they have to slow inflation, because that's the part of the sentence that like people don't say in Capitol Hill. Yeah. Like the Feds need to tackle inflation. The way you tackle inflation is you raise rates and you slow growth.
You slow growth. Exactly. So that's the problem with the strong retail sales number. Right. The problem with the strong retail sales number, it implies that personal consumption expenditures, all things equal, are going to be running at a 5% annualized rate. So significantly above trend. And if you still have above trend GDP growth, well above GDP growth, it implies that the financial conditions tightening we've seen is not enough to accomplish the Fed's goal of slowing growth / inflation. And so that's where you say, all right, we are pricing at a significant slowdown in the economy, and yet it might not even be enough yet. And it's like, oh, geez, like that's just the worst of all worlds. So in a way,
it's kind of like circular reasoning. Oh, the economy is good. Oh, crap. That means the Fed's going to tighten farther and then drive us deeper into recession. Yeah.
And we don't know how much or how long it's going to take them to tighten further. We don't know how much more financial conditions tightening is needed. When the economy slows, we might be going straight to recession. Hence, vol at 30 for 6 months.
And historically, the Fed always over tightens because monetary policy works with the lag. So it's not a sharpshooter. It's a shotgun.
It's a blunt tool. Bottom line.
Yeah.
I always find these conversations so interesting. So I want to ask you guys, what if you were in charge? What should the Fed do? And when should the Fed let up?
So if I was in charge, which would never be the case, they should be doing exactly what they're doing. I think, hindsight being 2020, they probably were too easy in the fall period, which kind of led to a little bit, maybe helped lead to a little bit of what's going on right now, meaning they're to catch up on monetary policy. But there's really no good outcome. I'm actually one of the few people, when I talk to clients, at least one of the few people in the world that actually thinks they're doing the best they can in a highly uncertain world. And so they should just keep on tightening. Yeah.
Yeah. We're kind of forgetting we're coming out of pandemic.
Right.
We have supply chain constraints. Though I think the part that's both underreported just in Main Street media, but also under talked about in financial markets is the extent to which they're doing quantitative tightening. So they're reducing their balance sheet. I think I have less criticism of them keeping rates low. And I suppose they could have started the reduction of the balance sheet sooner. And now they're doing it very, very rapidly, which also is very much tightening financial conditions. But more importantly, the whole point of quantitative easing is that the Fed buys a bunch of treasuries and mortgage-backed securities to push they basically corner the market. So the rest of market participants have to, in order to get a return, have to go farther out on the yield curve. I think that, we handed people money for 2 years, told them to stay home. And we also flooded the world with liquidity. That had a lot to do with the run up in stocks, especially last year. Also, we have to remember the S&P is down 2%, 3% from a year ago. We kind of inflated too much last year. So it's not, people are talking about the end of the world. We're back where we were a year ago when things got a little goofy,
And that's and the reason I asked the question is I think that so often, like commentary on the news and in columns about like, oh my gosh, what is happening? And it's kind of like, well, the Fed is doing what it has to in this moment to try to right the ship. And it seems very easy for like the masses to sort of forget about all of the conditions that got us to where we are, and they were extraordinary, right? I mean, in 2019, I think we were expecting there was going to have to be some bit of recession. Right now, we never expected it would be what it was, right? But things have to wax and wane. And now as we're trying to recover from this unbelievable moment in time that will be written about for centuries, it's like, what else should the central bank do?
Well, yeah, there is a narrative about the Powell Fed that they've been kind of oversteering into some of these moves. We saw this at the end of 2018, where they sort of oversteered into the tightening cycle, and then in 2019 probably swung the wheel a little too hard the other way. We were basically like in full on easing mode and nascent QE programs before, in 19, when the economy was still doing well before the pandemic showed up. So this was and then, hindsight being 2020, the knock on Powell is that he did it again. He overdid it into the stimulus. And now he's about to overdo it into the tightening phase.
And also it's kind of a big deal that Larry Summers seems to have been ahead of the curve and right about this one.
So Dennis, you've got to,
and people are listening to him. Yeah.
Yeah.
Anyway, go ahead. Sorry.
To go back to economists and intellectually vibrant and forward-thinking economists. You certainly have one of those working with you. And let's start with if we can get the base case among all the noise. What is your house view on the economy, and then how does that translate into your house view on markets going forward?
Yeah, and so our economist Gerard McNally's, you guys know him. He's excellent. Spent many years working at Point 72. So he's got a buy-side economist, which is a little bit unique. Not too many of those out there. In any event, as far as house view is concerned, he makes a point, which I was going to make anyway, as you guys were talking, of how difficult it is to forecast now. So having conviction is like, I think very difficult. And when I say conviction, like recession risk being a base case, certain calls on inflation. So it's something we should just keep in mind when we think about, how the Fed's going to react. I mean, there's a lot of different ways this can play out. So that being said, he makes a really important point now that, and I think this is the biggest arb in the market at some point, it's just not today, that although recession risk is higher, it's not a base case. You have to keep in mind that recessions are generally rare events. That's one. And two, that at least from a Fed point of view, if they're going to drive inflation all the way down to 2% core, then you're likely are going to end up in a recession, because to do that in most of the modeling would require an increase in the unemployment rate. All right. Now, one of the things that could plausibly happen, and some Fed speakers are hinting at this in my view. I can come back to why I think Bernanke actually mentioned it in an NPR interview. Reinhardt mentioned this in an interview as well. It's essentially saying that the Fed can accept some type of higher inflation rate. What that means is you get to some type of opportunistic disinflation, and I'll explain what that is. Back in the early 80s and 90s, the Fed actually let inflation stay above 2% for a long period of time. And the way you average inflation over a cycle is you let the next recession, whenever that may come, get the inflation rate below 2%. Of course, then you average it at 2%. So if we all know that going all the way to 2% on core is going to cause a recession, but inflation is too high right now, there probably is some middle ground in that 2.5% to 3% range on core, where you don't have a recession and the Fed basically backs off. And that's how you end up out of this situation where the Fed is not obviously increasing the unemployment rate, significantly damaging the labor market to accomplish its goals. That's a really important point, and I think actually pretty bullish at some point in the future. But for that to happen, we all have to have comfort that core inflation is going to be headed down to 3% roughly by 1Q next year. So you need that to happen. And if it's up at 4, trending at like 4 by, if we think it's trending at 4 by 1Q next year, then that's a problem. That's a major problem, because the Fed just has to keep on going.
And I think that you've pointed out that is a truly key point. And to roll back the tape, the Fed does not want to go to status quo ante, right? Inflation was too low for too long. And how does 3%? They've always wanted to get it higher and have that upside in inflation, and to have 3.5% inflation. How is that a victory? It's a victory if you're coming down from 8%.
Yes,
right?
Yes, it's a major victory if you're coming down. If you're attacking inflation from above, yes, that's
how you get there. And they've been trying to edge it up, without going over. And this is a more likely way for them to get to that higher inflation equilibrium. And we very much agree with that view. So you're orienting yourselves and your clients for this big paradigm shift when the Fed begins to when the Fed has the target in sight. And so what are you telling your clients to do in anticipation of that, whenever it may be?
Well, so in anticipation of that, the one thing that we struggle with is that the next 2 to 3 months are critical, and we admit, meaning it's critical to get to hopefully that next phase, which would be more positive. The reason we're not pounding the table bullish right now is because we actually have very low conviction that growth will be weak enough to back off the Fed near term.
Yeah, that's an interesting point. Yeah.
Right. So we have to get through what I call the death valley here of inflation and economic growth meaningfully turning lower. in a way that suggests the Fed can eventually back off. All right.
Yeah, because we've talked about that a lot on the podcast, where the economic sentiment is quite negative. The consumer's mad about inflation, but they're not behaving as such. They're still going out to Disney World, flying all over the place, going out to dinners.
Yeah, you can't get a reservation, but they're really pissed. Yeah. I get, it's funny. Flights are packed, but everyone's upset. I get it. We also have a problem here, John and Brendan, that I think is I think is pretty well understood, but I think not appreciated as far as what could be very negative over the near term, is that the reopening and service growth is pretty much baked in the cake through the summer. Bookings are basically done for travel and leisure through the summer. So you're going to have strong restaurant, travel, hotel spending.
Yeah, 90% of Americans are planning to travel in the next 3 months.
Yes. And now maybe in September, so in September, I would suggest that we would have much more clarity on, or much more visibility on an overall slowing of consumer, which gets you more comfortable on the overall trend rate of GDP and getting on that hopeful path to 3%. So I could see, crystal ball, obviously, it never works out this way. I could see late this summer, maybe around Jackson Hole, where you want to get really bullish. I'm just worried that it's from 3,200. I'm making up a number, guys. I'm not saying we're going there.
Yeah,
I'm just worried that it's
somewhat lower,
significantly lower than where we are today. So that's the boggle. When that does happen, I think you want to be very long the market leaders that have been under pressure here. So that's your mega cap growth names. And I do think you just want to be cyclically oriented, because the highest valuation and the only thing that's worked is basically low volatility. And like when I say low volatility, it's low volatility factor. So that's like your classic defensive staples, utilities, and all those staples are now coming under pressure. So your classic just kind of defensive names will suffer when that happens. But
are you seeing any indication that the sell-offs in the crypto market is seeping its way or affecting the equity market?
Not really on the equity market. I think it could on the retail side, which we don't have a very strong view on, but I don't think it is, other than everybody trying to short, MicroStrategy and put that guy out of business. But
and things like that.
Things like that. But I don't think it.
Earlier before the pod, you were saying you had just come back from San Francisco, and the sentiment on the ground there is really negative, right?
It's very negative in tech land. San Francisco seems to be less Bitcoin-ish than or crypto-ish than Miami or Texas, though. So it's odd, and I shouldn't say it's odd. It's just that's the way it is. But San Francisco, yes, the sentiment there is very negative. There is a realization, and this is important for investors, I think, to understand, is that say we have a long call in the market later this year, it's going to be in stuff that actually has profits versus this subset of company that is basically 99 all over again. So it's not,
and that's a really important point, because I've had done a few interviews with financial journalists, and they've asked me, is this 2000? Is this 2008 again? I was like, it couldn't be any more different.
Yeah. So it's you have a subset of companies that are dead, or not dead, but they're just, you know what I mean? Like they're just overvalued, no earnings. You probably have, even under a non-recessionary scenario or recessionary scenario, rates go lower, but your long-term interest rate or interest rate volatility is probably going to be higher longer term. So those names are in trouble. Actually, it's a very interesting long-short opportunity now. Vol's too high to put this on, which is the thing that investors keep saying to us, is that, I get it that you want to be very long profitable tech and short unprofitable tech right now, but the vol's so high that it's very difficult to do. That's why you can get volatility down. Yeah.
You can't wait it out. You'll get stopped out with all the huge moves in between.
Yeah. So someone, you guys would appreciate this, having done the job. Someone said to me, it's people don't realize how hard it is to get your shorts in particular from the unrealized gain column to the realized gain column. He's like, so on paper you make this and then you try and cover, and then there's a market move and boom, all of a sudden
it's all gone.
It's all gone. So so crypto, by the way, I think so we've seen 2 trillion or
something
maybe
like
less come off. So total household net worth from 2019 forward was plus 35 trillion. So crypto, from an economic point of view, I don't think makes much of a difference. difference.
It's also it's something like 90% of Bitcoin and Ethereum is held by like 30 people.
Yes. So, and those guys, are not important to aggregate demand, as we know. No. They'll be able to spend either way under pretty much all scenarios.
Yeah, because they bought it at $1. Yeah.
Yes, they're all billionaires. A lot of them were billionaires looking to hedge their wealth out.
Exactly.
In some way, shape, or form. So,
I do think a lot of retail got involved at the highs, but they got involved, with $5, $10, $20,000,
yes.
not with their entire 401ks.
Yeah. So there'll be some impact. I'm just, what's more interesting to me is that even, like I look at the labor income proxy. And so everybody knows labor income proxy is basically your wages plus hours worked, right? So a lot of people look at real wages, which are negative, but if you actually adjust for hours worked, real labor income is positive.
Oh, really interesting.
Yeah. So like your labor income proxy. But why is that the case? Very interesting. Participation is so low that people are doing more hours.
Yeah.
So you've seen this like stair shift up in hours worked. So when you adjust for hours worked, the labor income proxy that's why retail sales are presumably very strong. So that's what actually makes me the most nervous out there for the market, is that despite what we've seen in this financial conditions tightening, it's just not enough to slow demand. It's just not enough. And the Fed has to be more aggressive or signal that they need to be more aggressive. Stocks need to go down more. Credit spreads need to go wider. Default risk needs to increase. And that's what I think the biggest risk is right now, is that over the next 2 to 3 months, growth is sticky or annoyingly strong.
Yeah, and you've actually had in the last 2 days, Mester and Kashikari actually addressed the stock market, saying kind of, we're not targeting it, but we're not upset that it's going down.
Oh yeah, I mean it's all part of the financial conditions channel, right? I mean,
exactly.
It's part of financial conditions, and it works through that's how this channel works. It doesn't have to be stocks; it could be other things, but it appears that stocks are doing a good part of the heavy lifting here. So now the $1 million question is: have financial conditions tightened enough, as it stands today, to meaningfully slow demand growth / inflation? And if the answer to that question is yes, I'm bullish. Bottom line.
Yeah. And that's what makes this scenario so interesting, too. Going back to Meghan's point, that this time actually is different. We're coming out of a global pandemic. We also now have China on lockdown, and we have a war in the Ukraine. So those are two pretty enormous exogenous factors that are screwing up the supply chains. Yeah.
Yes. And it's also why it goes back to my earlier point, having conviction on outcomes here, especially 6 months or more on the macro side, I think is difficult.
Yeah, it's difficult in normal times, and now it's almost impossible. Yeah.
That's my way of pushing back against the recession is certain crowd. Fine, we might be going into a recession. I do think the Fed would rather avoid it, but monetary policy is a blunt tool. We'll see. I just don't know why people are so convinced it's 100% likely.
We're exactly in your camp. I just don't. I think the economy is too strong to go into a recession in the next 12 months. 2023, a year from today, is a very different scenario, because going back to the Fed can put us into recession if they want to.
Absolutely. The good news is we don't necessarily have we have obviously the war, we have China, but from a U.S. point of view, we don't have the negative feedback. We don't have the potential accelerators or negative feedback loops. Corporate debt is extraordinarily low, right? So you have a household, a private sector surplus that is, significant relative to history. Obviously, that's the mirror image of the public sector debt. But yes, you have a private sector surplus right now. You don't have a lot of private sector leverage, so theoretically, you don't have those negative feedback loops develop in a tightening cycle like you have, say, in obviously 2008, but even to a lesser extent, 2000. And
even the same at the public level, at the state and local level, you're seeing huge surpluses. Mm-hmm. Which going back, we handed out a lot of money in the last 2 years.
Yeah, it was a tragedy, as you guys know, it was the tragedy of 2008, where we let just speaking of that, on the 2008, coming out of that, right, the state and local government level, there was significant fiscal contraction for like 3 or 4 years.
Yep.
Right, even after the initial fiscal burst, and that was a pretty significant drag on aggregate demand. So theoretically, you don't have that drag this time.
Hey guys, let's take a short break and then come back, and I think we're going to talk a little bit more about inflation.
Check out HPS Insights, a regular podcast from Hamilton Place Strategies, bringing you the latest on policy debates affecting the business and political communities. Available on the HPS podcast channel on your favorite streaming platforms, including Apple, Spotify, and Google. Tune in to the latest episodes and learn more at hamiltonplacestrategies.com/podcast.
And we're back with the HPS Macrocast. So let's get into it. Inflation. It's the talk of the town. We saw the new White House press secretary really kind of muck it up when Peter Doocy from Fox News posed the question of how does ticking up corporate rates fix inflation? And she really did not have a good answer, which, that stung for her. And it's a new, really hard job, but it is the topic that everyone is talking about. It's on, the headlines of our newspapers. It's on.
And the Pew polls, 70% of Americans view inflation as, the biggest thing in their life. Healthcare is at like 53%. So it is a political issue, and we're going into the midterms. And I suppose now we know kind of who's running too, except for Pennsylvania.
Right. But so do you all feel like that's overblown? I mean, is we were just talking before about the unbelievable circumstances that we have been facing over the past few years and even that we're facing right now. Is it to be expected that inflation would be an issue? Are people properly concerned, or is there a lack of understanding about what's actually happening in the economy and maybe some of the fears are overblown?
I don't think it really matters. So once Volcker kind of, tightened the economy back in the late 70s, early 80s, we then also hit a demographic boom of the baby boomers come. So, since the mid 80s, we haven't had inflation. We've been in 1.5% to 2%. So we have an entire generation of people that really have never experienced anything of significant inflation. So it's understandable that people are pissed off.
Well, I think you have inflation, then we have these supply chain issues. The baby formula shortage is obviously heartbreaking and scary. And I think it's difficult for people to parse what is what. They just know that there's stress and they're paying more at the gas pump.
Yep. And food is more expensive too.
And everything is just ticking up a little bit. And it feels like, how much more can we take? So I guess my question to you all is, how much more can we take? What does this story look like in 6 months?
Well, I think some of the commentary from management and it was basically like Walmart and Target. This is important. Earnings. They came out and said, look, we've got, sales are still good, but the skew in purchasing is going toward the staples, right? It's food, it's gasoline, and the rest of the spending basket is suffering because of that, and people are having to reallocate that marginal dollar to keep up their grocery purchases and what they're used to on that front. It's hard to say that this isn't, to a great degree, a supply shock. We're seeing dynamics that are increasingly highlighting the narrowing of inflationary pressures to energy and food. If you're looking at like industrial metals, we used to have this, from a commodities perspective, everything was going in the same direction, but that's not really the case anymore. You're seeing industrial metals prices suffering because of the China property slowdown and so forth. You're seeing rail loads and other freight rates coming off. Now, investors are still bracing for the shockwave that's coming from China's lockdown through the supply chain. There's an expectation that hasn't fully been realized yet, but there's still there's increasingly a sense, and I think this will be something that allows the Fed to do the downshift that Dennis had been talking about before, where they have, softening inflation in a bunch of different categories. And it becomes clearer and clearer that this is really an energy and food focused supply shock rather than some sort of generalized monetary phenomenon.
Yes, I think that's a really important point, because you have to separate it out when talking about public perception of inflation, and to a certain extent investors, is the supply and demand aspects of it. So obviously you have the supply shock, and you ask, all right, what does 6 months from now look like? The happy scenario is the supply shock starts to alleviate itself, inflation comes down, and you don't have to ratchet down aggregate demand at the same time. You don't have to slow the economy aggressively because your supply side is improving. That's really important, because what we're not talking about, and what is not talked about enough in the public, and I don't know if I want the public talking about this because it would create enough Twitter nonsense that I don't want to deal with. But what I mean by that is essentially the Fed has to push up the weakened labor market significantly to slow inflation.
Yep.
What you like a 6 months from now, really unhappy scenario is when people realize, like, well, yeah, I was really pissed about inflation, but the way you're solving it is taking away jobs.
It's so important. Yeah.
I didn't sign up for that. Like, so they can be pissed about it now. Like, how pissed are they going to be about it when they're like, oh, we had to do that. We had to take away jobs to make this work, or significantly weaken the labor market. Theoretically, they don't have to do that if the supply side improves. So that's a really important distinction. I would also say then a lot of the inflation we have had is because we've been in a bit of a demand boom. A lot of that has to do with fiscal stimulus. So growth has been well above trend. And, that's not a bad thing. Just as a side note, I get it. People are pissed about inflation. So I do wonder, what these surveys are actually picking up. I think they're picking up very specifically that people don't like supply constraints. They're perfectly happy with higher wages. Let me tell you that. They're perfectly happy with higher wages. They don't want to see that taken away, which the Fed is trying to accomplish, by the way. Unhappy with supply problems.
Got it. Well, gang, what's coming up next? What do we have to look forward to?
It's a more quiet week next week. There's the global PMIs, the manufacturing PMI. So that'll give us a good indication of how the manufacturing sector is doing across the globe. And I think that's kind of the big one. We don't have any central bank meetings next week, do we?
Not big central banks. We've got U.S. personal spending and income data.
Yes, actually. So we do have a big data point. I'm sorry.
Yep. Yeah. That includes the Fed's.
Yeah, this is the Fed's preferred price measurement, the PCE price index. So they focus on the core, and they target it at 2% over time. And correct me if I'm wrong, I believe we're at 4.6% on core PCE.
That sounds right.
I'm looking now. I think that's about right.
Well, okay, so we have some good data coming up to give us a better idea of what's actually happening out there.
Yep, inflation.
Listen, everyone, thank you so much for listening to the HPS Macrocast. It's been great. Dennis, thank you so much for joining us. This was fantastic. I hope you can come back again soon. I'm Meghan Pennington with Hamilton Place Strategies. And of course, thanks as always to John and Brendan from Markets Policy Partners. Thank you all for tuning in and listening. Have a great weekend.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.